Hi, my name's Steve Clapham. I'm the founder behind The Balance Sheet. I'm a former partner, head of research at two multi-billion-dollar hedge funds. I've got decades of experience in looking at equities, and I'm here to share my learnings over the years with you on this YouTube channel, absolutely free. Why am I doing that? Well, I have a training business and I am looking to sell investing courses, which I'm going to tell you about in a minute. But before I talk about those, please go to my website, behindthebalancesheet.com. Do this right now. Sign up for our free newsletter. If you do that right now, as I'm doing this just before Black Friday 2021, you will be able to be eligible for a fantastic discount off one of our investing courses for private investors. If you're serious about investing and you want to improve your skills, I highly recommend you check out these courses. They're really good. We have a lot of very happy students. But let me get on to the video. The second in our Finance Demystified series, and what I'm going to talk about is 7 flaws with EBITDA. EBITDA is a very overused term. Finance professionals talk about it all the time. EBITDA this, EBITDA that. And often they don't know what they're talking about. The great thing about the stock market is that it is full of charlatans who are there to try and relieve you of your money. I'm here to try and help. So the first thing you need to know about EBITDA is that it's overused. And the second thing you need to know is you need to distinguish between the actual EBITDA as reported and the company's own adjusted number. And many companies will fiddle their EBITDA number by excluding all the bad stuff, as Charlie Munger put it. If you want a great example of this, check out the video on the channel on the Hut Group, because they have managed to turn a 500 million loss into 150 million positive EBITDA. And I explain how they do it and why it's wrong in that video. It's worth checking out. But let's just go on. Don't rush off. Finish this video first, because we've got some great stuff here. 7 flaws, starting with the first problem with EBITDA is it ignores working capital growth. Most companies, in order to grow, need more capital. Almost every company does. You need more fixed assets, more factories if you're manufacturing something. You need more intangible assets, often if you're an asset-light, high-tech company, for example. But almost every company, even tech companies, need working capital. Their customers don't pay them immediately. I mean, there's a few companies where they've got a subscription model where the customers pay them in advance. But generally speaking, the problem with EBITDA is it ignores the growth in working capital, and it therefore overstates cash generation for most companies. The exception to this are the few companies with negative working capital. Think of a supermarket, for example, where you buy the product, you pay cash for the product, and the supermarket pays 45 days later, it pays its supplier. So it's got the benefit of your cash for 45 days. But those companies are quite unusual, and there are some particularities about negative working capital, which I'll cover in a future video. Number 2, you'll often hear people talking about, oh, this company doesn't have a problem, it generates EBITDA of $500 million. That's fine, but it's only one side of the equation. You've got the other side of the equation is the debt. EBITDA is totally misleading as a liquidity indicator. It tells you nothing about the liquidity of the company. You can only put it in the context of the company's balance sheet. Number 3, it is not a common denominator for cross-border accounting conventions. Simple example of this would be 2 pharmaceutical companies, one in the US and one in the UK. The company in the UK has a policy of capitalizing R&D. That R&D, it spends 100 million a year in R&D, it's added to its balance sheet asset, and it's amortized over time. When you look at the UK company's EBITDA, it's X that R&D spend. The US company, the 100 million it spends in R&D goes straight through the P&L. and it comes off EBITDA. So the UK company will appear to have 100 million higher EBITDA. And the accounting rules say that's what it has. But it doesn't have 100 million higher cash flow. So you could be very careful about some of those cross-border accounting differences. EBITDA ignores required reinvestment. Think of a company like Hedge. It's constantly having to buy new cars. It's constantly having to find the capital for those cars. But EBITDA looks great because it doesn't include any of that reinvestment. That's why I think when you're looking at valuation, you should think about EV to EBIT as a useful supplement, complement to EV/EBITDA. EV/EBITDA often used for comparing acquisition multiples, and there's a good reason for that because different companies have different debt and often different tax positions. But you cannot say company A acquired for EV/EBITDA of 12, company B acquired for EV/EBITDA of 10, therefore this company is going to be somewhere in the middle, say let's call it 11, because it's inadequate as a standalone measure. You can't look at it in isolation. Number 6, and this is one of my favorites, it probably should be number 1, the IFRS 16 effect. Now, you don't want to get me started about the accounting rules, because I think the accounting rules are really fundamentally flawed, and IFRS 16 is, it's awful. It really is. It is a terrible accounting standard. So, under IFRS 16, there is no such thing as an operating lease rental. You tell that to any retailer in this country, where you've got a lease, you've got an operating lease rental. But because of the IFRS 16 changes, the operating lease rental is not a deduction for EBITDA. So EBITDA completely ignores what you're paying for your properties. So it completely overstates any cash generation measure. And again, if you're comparing companies cross-border, this could be a real problem. That's a really, really major flaw with EBITDA today, because EBITDA today isn't EBITDA, it's EBITDAR. Earnings for interest, tax, depreciation, amortization, and operating lease rentals. That's a real problem. And of course, EBITDA doesn't give you any clue as to the quality of the cash flow, because companies have all sorts of differences, particularly accounting. Think of 2 companies with 5 million EBITDA. One of them sold a property and made a 1 million gain. So its EBITDA is really 4 million, not 5 million, but they both represent themselves as having EBITDA of 5. So you've got to look at EBITDA with a careful eye, as with all these financial measures and parameters. So I hope you've enjoyed that. Don't forget, sign up on my website, behindthebalanceSheet.com, to get the free newsletter. Subscribe to the YouTube channel to get more videos like this. And don't forget, we've now got a podcast, and the podcast has been super popular. I really, really highly recommend it to you. And if you enjoy it, please do me a favor, leave a review on iTunes. That will really help me. So that was it. Finance Demystified. I hope you enjoyed it. Don't forget, subscribe to the channel. See you next time.